Where do you live?
Between DC and here.
Okay.
So I split my time.
Where are you more often?
Here. I'm here pretty much. Our office is 3 blocks up from you.
So why are you also in DC?
That's where I built the home podcast studio when I started AGM during COVID.
You know, you could move the microphones.
I could. I know I could move the microphones. It's a cool background though, so it's hard to.
So I listened to your show and I really liked it, and I know it's very long running. You've done a ton of episodes.
He caught it, but he caught one.
No, you can do it. You're good. You're good.
Appreciate it.
Yeah,
so
yeah.
Michael,
it's good to hear from another podcaster.
I thought that this episode was just going to be. I thought I was going to be in this seat. Josh was not supposed to be here, so I invited you.
Well, surprise, surprise.
So I invited you and somebody who canceled 24 hours ago.
Dead to us, right, Nicole?
And I'm not going to name companies. I'm not going to name names. I'm not going to do it. No, I'm not going to do it. But let's just say it rhymes with.
Stop. Stop.
Do it.
And listen, you are not encumbered by corporate speak. You can say whatever you want.
I saw the person's title, and I don't know how they even got into our show.
What do you mean? Where did
this person was like the vice president of human resources or something.
No,
it's like
stop it.
It's not CEO. It's not a portfolio manager.
It was not. It was.
I would have edited this person out if they came here.
It was none of those things.
Right, I only want to hear from Michael.
But I guess like there's. I thought the doc looked kosher to me. Like if there's too much smoke. Come on.
Some people can't handle the truth.
Some people can't handle it. All right. Well, you can handle the truth.
I will say it does bring up an interesting point in this space is that I think firms take their brand very seriously.
As they should.
Agree.
Yeah.
But at the same time, they may have to recalibrate some of that as they think about working with the wealth channel.
Well, they're going to lose because John Gray is not taking himself seriously. And Harvey Schwartz is not taking himself seriously. I think the leading avatars for the private equity market are people like David Rubenstein who mix it up with the crowd and have unexpected conversations and are not scripted when they do media. They're going to win because that's what the advisor audience responds to. So if you want to come on and read your PR talking points, you're not going to do that here, right? I don't even know where is the venue for that. Yahoo Finance, like where could you go where they're like, tell us what questions we can ask you. I don't even know if that even exists anymore. So anyway, you ready for this?
Yeah, I'm ready. I thought we were going. I was ready.
We're going. We start recording you the minute you get off the elevator. I don't know if you know this.
So you've been potting for a while. When did you start? A couple years ago.
April 21 was the first podcast.
Okay, this show started in June 21. So
oh really? Okay.
I think a lot of pods were born in that era because none of us knew what to do with ourselves. Okay,
we can talk.
Yeah. How many episodes have you done?
170.
It's amazing. Congratulations.
Thank you.
Congratulations. How many have we done?
206.
Not to brag.
I gotta pick up the pace here.
Yeah, those are rookie numbers. Come on, Michael.
Yeah. Are you, as far as you know, the predominant podcaster in the alternative asset space? I think you probably are.
Focused on the intersection of private markets and private wealth, yes. Ted has obviously done this for.
But Ted goes way more hedge fund than you do.
Ted's more institutional. I feel
Ted's more, yeah.
Do you not consider hedge fund? So I haven't done as much on the hedge fund side, and then I would think of hedge funds as alternatives. I think what they haven't done as much of is work with the wealth channel in the same way that the larger alternative asset managers.
They tried. It didn't go well. The returns were bad. But
we'll see if they try again.
They had their moment 15 years ago after the financial crisis. And unfortunately, it was like the worst time to get into global macro.
Yeah.
But that's what all the advisors were looking for. They wanted the people that called the crisis correctly. Unfortunately, those people then went on to predict 10 other crises. And the end result for wealth management clients was, when can I get out of this thing? So, and you know this history.
Well, this is, I think, an important thing to talk about in the context of evergreen funds, which I'm sure we'll discuss, which is how should advisors think about investing in private markets? And
what's evergreen funds? You buying like Christmas trees? I'm kidding.
Yeah.
No, I agree. I'm going to do a lot of questions with you.
Yeah.
Mostly because I have not paid close enough attention to this space over the last 5 years as I should have. But also our audience, we have a lot of people working in wealth management and a lot of people who are the clients of people working in wealth management. And I think it hasn't really dawned on everyone that the era of 3 basis points Vanguard, you don't need anything else, Like, I don't think everyone has accepted that investing era is over and we're in a new era. So I think because of that, there's a lot of just, I don't want to call it ignorance, but there's just like a lot of, I'm too afraid to ask these questions. What is an interval fund? What is this? So I'm going to pepper you with like, give me definitions as we discuss.
Sure.
Wait, where's your computer? You have Investpedia open. How are you going to do this?
No. But like when you talk to Ted Seides, you guys are speaking at a level that makes sense given his audience, which is institutions. My audience, they want to learn. But like they're not ready to hear some of those terms without us pausing and saying, what does that mean?
Which is good. I mean, I think, look, like that's one
missionary work. It's missionary work.
Of course. But all the firms are doing that. Like what's Blackstone doing? Blackstone University, Apollo has Apollo Academy. Et cetera, et cetera. And they all know they need to educate the advisor. We did that at iCapital. That was a huge part of what we did. The iCapital is still doing it today. But that I think is a hugely important piece.
Education is marketing.
Yep.
These firms pay for their education, their universities out of the marketing budget. Nothing wrong with it. You know who I had here the other day? I had Shanali Basak here.
Yeah.
And I think she maybe has like the most consequential role in this ecosystem out of anyone, because she's like basically going to be the face of ICAP and the voice of ICAP when she starts doing media.
Did you know Michael is one of the first employees there?
I know that.
First, helped build the sales team. Number 9.
Okay.
Number 9.
And so she's like, I'm so excited because, working at one private equity firm, basically that's the whole story that I have to tell, and that's the whole job is marketing that. But sitting at iCapital, I work with every firm, and I can really put my contacts to good use.
What are we doing?
By connecting people from all over the ecosystem. So
right?
I think she's like perfectly positioned for.
And that role is critically important, right? Like somebody has to connect public and private. Somebody has to make sense of what's going on in the industry, what the different firms are doing, how they're doing it, how advisors think about private markets, how to fit into a portfolio. All those things I think are top of mind, right? And they're going to have to think about, and the productization around it. There's model portfolios. Different advisors have different types of clients. All of those things.
All right, hold your thought.
So
let's start the show. He's brimming with information.
We're going. Here we go.
Today's episode is brought to you by WisdomTree. Enhance your portfolios with expert insights from WisdomTree. WisdomTree's Portfolio Consultations provide a comprehensive review that includes unbiased, forward-looking investment ideas tailored to your needs. The experienced consultants at WisdomTree leverage insights from a global research team to offer fresh perspectives and help you achieve your clients' portfolio goals. WisdomTree offers a range of services, including individual fund analysis, asset allocation guidance, portfolio stress testing, risk deconstruction, and more. The review includes a detailed analysis of your portfolio, helps pinpoint unforeseen risks, and includes actionable insights. Connect with WisdomTree for a no-cost consultation today. Visit wisdomtree.com/portfolio consultations. Before investing, carefully consider a fund's investment objectives, risk, charges, and expenses contained in the prospectus available at wisdomtree.com/investments. Read it carefully. There are risks involved with investing, including the possible loss of principal. Oh my God. Episode 207. Ladies and gentlemen, we're now listening to one of the best investing podcasts in the world. We have a very special guest here today. He is a podcaster, thought leader, operator, expert in an area of the market that is in one of the biggest bull markets any of us have ever seen. Super excited to learn from him today. Maybe push back a little bit. We'll see what happens. Either way, we're going to have some fun. Michael Sidgmore is a partner and co-founder of Broadhaven Ventures, a global early-stage investor that makes principal capital investments in financial technology companies and venture capital funds. Michael is also the founder of Alt goes mainstream. No S, alt.
No S.
All right,
That
you
always
got it.
trips me up too. You should change it. It's not too late.
I've
not too late.
thought about
just
that.
do it,
I've
just do
built
it.
I've built out the brand.
Nah, just do it.
If you added an S, nobody would care.
Yeah.
The brand is you, as you know. It's not like somebody else could sit in the seat and do alt goes mainstream. You're the brand.
Boy, Michael,
Okay.
you guys are also an investment bank.
Yes, we have an investment bank called Broadhaven. About 65
I said
people.
that. You didn't listen to my.
I wasn't listening. I was distracted. No,
Yeah.
you didn't say that. You
I
didn't say
literally
that.
said it. Co-founder of Broadhaven. Do I have to play the tape or can we?
That makes principal capital. You didn't say they're an investment bank. I said it. You didn't say it.
What do you mean? What is Broadhaven Ventures?
We're the principal investment arm that sits on top of the investment bank that my
So I
partner
said
started.
I said it wrong. What you guys do?
Not what
Yeah,
I
you
do.
didn't say it. It was
You-
just-
you
no,
should
no,
say
no,
the
no.
other
He said-
piece
it
of
was-
it.
Boy, he knows what he said.
It was incomplete.
All right. Just kidding. Michael, it's so great to have you here. And I've been overdosing on listening to you over the last couple of days, and I'm so excited to have this conversation. Let's start with this. How big is the alternative investing market right now? Give us some sense of the scale as we sit here today.
Yeah, so I'll go from a chart from Brookfield, which is probably based on some other data, like the Bain companies, the Preqins, et cetera, of the world. About 25 trillion of assets in alternatives or private markets today. Now, private markets is not just private equity, which is what we may think of. It's also private credit and hedge funds and infrastructure,
Real
and
estate too?
secondaries,
Private real estate? Yeah.
GP stakes. So
Okay.
it's about 25 or so trillion today. Private equity is the biggest asset class within private markets. Now, over time, let's see what happens with things like secondaries. I think if there's going to be a $50 billion fund that's raised, secondaries is probably the first place that would happen. Just 'cause you
Secondaries
can-
is private equity funds that have holdings they'd like to get liquidity on. A secondary fund would come along. It's just another private equity fund, but they specialize in buying those assets away from the primary.
Correct.
All right. Why is that so vital and necessary right now, the secondary? Is it because there's a lack of liquidity?
To some extent, yes.
Okay.
So there's in today's world of private markets, yes, absolutely. There's been a lack of liquidity, lack of distributions, mainly because the institutions, and we'll talk about this as it relates to the wealth channel. I think that's all part of the story here, is that part of why the alternative asset managers, the Blackstones, Apollos, KKRs, et cetera, of the world are choosing to work with the wealth channel is because institutional investors have reached a point where they're relatively fully allocated.
15-20% invested in
Sometimes
alternatives.
more.
Yeah.
I mean, the Yale, Harvard endowments are sometimes
So when I hear
30,
that
40%.
stat, I hear it cynically. Like I hear it like the institutions can't physically buy any more of this stuff. We need a new buyer. Hey, we're super interested in democratizing this for wealth management. I don't mean to be cynical.
How
but
could you
it's-
not be?
But how could you
Obviously.
not
Come
be
on.
when that's the rhetoric?
A very fair question of private markets. I think there's certainly some truth to that when you think about alternative asset managers as businesses. Their customers are their LPs. So institutional LPs are their customers. Now the wealth channel is another customer of theirs. And particularly as some of these firms are in public markets or have taken investments from GP stakes firms like so they've taken in capital to grow their business.
We
and
don't
they
say
need
that name here.
and
Dead
need
to
to
us.
grow their business.
Dead to us.
They need to think about other pools of capital. It's not just private wealth, it's insurance too. Insurance has been structurally underallocated to private markets, and that I include like things like private credit in that relative to institutions. But I think let's put that aside, the cynical aspect aside for a second, because I think there's another
Can we start
side
with
to
the,
this.
Can we start with the cynical
Sure.
side? Just lean into it a little bit
let's
more.
not get it. Let's get it
Yeah,
out of the
let's
way.
just get it out of the way.
for sure. So look, I think
These are very these asset managers are the best in the world.
Yeah.
They're very good at generating revenue and profit for their shareholders and,
Yep.
and themselves.
they charge higher fees.
And now they're all buying insurance companies because like it's a never-ending supply of money and investments and fee-related earnings and profits and carry and all that good stuff.
Sure. So I think you hit on an important aspect from the business of asset management, which is they charge a management fee and they charge carry. As you guys well know from the evolution of the mutual fund industry, the rise of ETFs, the traditional asset managers who also are getting into private markets in a big way, whether
Yep,
it's
all of them.
Franklin or T. Rowe,
All
or
of them.
BlackRock, et cetera. they've seen a fee compression in traditional asset management. That's the way the mutual fund industry went. And alternative asset managers generate higher fees. So I think if the
Wait,
institutional...
I'm hearing that cynically too, though.
Sure.
Okay.
So the
right.
next piece of the puzzle here is the institutional side. As they've become bigger consumers of private markets, there was a wave in alternative asset management where big institutions, think like the Maple 8, so the big Canadian pension plans, Ontario Teachers, the CDPQs of the world, et cetera, they started going to private equity firms and saying, hey, we want to co-invest alongside of you, or we want to build out a direct investment capability. Why did they want to do that? In part because they wanted access to this part of the market, but in part because they wanted to blend down their fees.
Yeah, strip out the fund. We don't need a fund. We're coming with money. You have the products. Let's do it that way.
So
smart.
There's definitely a piece of that where I think we've moved away from 2 and 20 is the common parlance, right? 2% management fee, 20% carry. That's more likely the case to be in private equity than it is in private credit. And there's a reason for that. There's, some element of like, you have to hire the team. They have to find the companies. They have to do the diligence. We could debate whether it should be 2 and 20. I don't think it is 2 and 20 anymore. I'll use another example of, certain fees have gone down. So like EQT is one example. They're a big 270 billion euro private equity or alternative asset manager. Their fees have stayed relatively constant. About, if you look at one of their last management presentations, about 142 basis points or so. That stayed relatively constant. It's not 2% anymore. And that gets to your point of the fees have come down in private markets. Will they come down to true vanguardization of private markets? Probably not.
Well,
I actually think they should be high.
Yeah.
It's a very complex thing to manage a portfolio of privately held investments. They should not look like an ETF. So we agree there. I guess what I'm trying to figure out is, and maybe there is no good answer. Maybe this is just the way it is. I heard you talk about, you estimate there's $250 billion in private equity. That's just wealth management channel money. And I think you're including the Merrill Lynch and the Morgans, who have always done private equity investing. And now the mega RIAs, Osaic, Creative Planning, et cetera. Is that the number? Is it a quarter of $1 trillion in wealth money?
I think that was specifically related to the Evergreen Fund.
Oh, just Evergreen. So it's more than that.
Yeah, and just Blackstone.
Yeah, it's just Blackstone.
Yeah, Blackstone. So Blackstone is that 250. Roughly speaking, it's probably a little higher today than when I
So where do you
said
think
it then.
So where do you think it's headed? Like, but let's say end of decade. Like, what do you think that number is going to look like in dollars?
We're certainly talking trillions of dollars from the wealth channel.
Okay.
So here I'll break down the
I think you're going to be right.
So about 140 trillion of assets on the institutional side. There's a roughly similar number on the global private wealth side, individual investor side, about 145 trillion or so. This is data from Bain and Company's private equity report out every year. Private wealth is around, roughly speaking, around like 1 to 3% allocated to private markets.
So rounds to zero, basically.
Institutions are 15 to 20.
Yeah.
So maybe it shouldn't be 15 to 20 in the next 5 years. And that depends on the client. Family offices have invested in private markets in many cases for years.
Yeah.
If they're qualified purchasers or qualified institutional buyers, they're probably having some allocation to either private equity funds or companies directly or other parts of private markets. But when we think about how early it is, to your point, like the Osaics, the LPLs, the Schwabs, the Fidelities, they're just starting to get into this now. Some platforms, the Hightowers, the Focuses, the Dynasties, these RIA aggregator or roll-up platforms, and then private equity-backed firms, they're getting into it, and some have advisor teams that are doing it. But even still, there's still relative underpenetration. I would say this is, again, rough numbers, but I think it's the 80-20 rule, maybe even the 90-10 rule of, at many of these firms, even the big wirehouses, there's 10% of the advisors are doing 90% of the flows today. So I think it is going to be in the trillions.
Let's put a pin in that, because that's an important stat for us. Michael, do you agree with the statement? The more former wirehouse advisors work at an RIA, the higher the likelihood that that RIA is actively allocating to alts.
100%. Because wirehouse
Because
guys,
they learned that when
they're
they were
selling
at the.
performance and RIAs were typically selling planning. So it's just a very different mentality.
So when you say like Hightower Dynasty, everyone that works there used to work at Morgan Stanley and Merrill Lynch, and they spent 25 years, let's say, a guy in his late 40s, early 50s, spent 25 years telling their clients the reason to have an account with them was performance. So, and they used alternatives as part of their pitch. They don't really believe in financial planning. Now they have some young CFPs. They throw the kid at a client. And they're like, hey, do a financial plan for this guy. You do it, and then they get to check a box and get higher compensation. There's not like a hardcore wave of CFP believers at the wires. Nothing wrong with that. Just pointing out what it is. The clients actually care more about performance than meeting with the CFP kid. So it's a nice fit. Those are the people who, when they break away, they go to Dynasty or Hightower. Those are the people most likely to take meetings with Blue Owl and Carlyle and all these firms and want to know, like, which of your products can I include in my portfolios, because I'm going to be pitching the performance of these products.
I think it's a really important point in two contexts. One is you have,
But I think that's what's changing.
yeah. So these things are all
What in the world?
Look at this fucking
What is that?
Velociraptor.
That
You
is
ever seen anything
ominous.
like that?
That is ominous.
Nicole!
Wow.
All right, never mind. I'm sorry. A raven just perched on your shoulder. It's not an omen or anything. I wouldn't worry about it. I wouldn't think too much
for
about
private markets or for public
Yeah,
markets.
no, this will be fine. Jeez, unbelievable. Yeah, it's a black raven. I don't even know what we're saying, but one other aspect of this that's
it. No,
important.
let him cook.
What,
let him
what,
cook.
what were we talking about? The bird?
So one, definitely not fly eagles fly. We can all agree on that.
Yeah,
No.
fair.
Commanders fan.
Yeah. Well, we'll see what happens this year. Sports is a piece of that. We can talk about sports. I think that's another interesting element of all of this too, and it relates to the branding and the collision of culture and finance, which you guys have done a great job of covering in a number of ways and bringing to life. But that, I think, is actually part of the story here. But before that, on the point about the advisors thinking about this from a business building perspective,
Yeah.
I don't think we can ignore the trend of private equity investing into wealth management
I agree.
as part of this.
Say more.
So
You
think-
just interviewed Carl about this, Heckenberg.
Yep. Carl is one example of that. He has a fund called Constellation Wealth Capital. He raised $1 billion or so in his first fund to take minority stakes in RIAs. So the likes of Crescent and Lido, AlphaCore, which is alts-focused RIA. And I think that's a good example of this. One of many. I mean, many private equity firms have invested into either platforms like the Hightowers, Dynasties, Focuses of the world, or in creative planning. General Atlantic's an investor in creative, TPG more recently as well.
Bain and Mariner. Not Mariner. Carson.
Yep.
Right. So the private equity funds come in, they buy a stake in the RIA. All of a sudden, the CIO at the RIA, the chief investment officer, is way more receptive to private equity.
Well, they need to grow the business.
Yeah.
And I will say this. So there's two sides of the coin. One aspect of it, and again, I think the most important aspect is they're fiduciaries. At the end of the day, they have to remember that. The other side of it is from the business building perspective is when you think about what private markets can do to a portfolio, we can get into the certain aspects of this, but private equity or private credit, it's not daily mark to mark in many cases. Now, certain structures are creating more frequent marks, so get evergreen funds, but the traditional closed-end drawdown structure private equity fund, they mark once a quarter. And that valuation is not daily mark to mark like a public equity portfolio. In periods of volatility in public markets, that can be a challenge for a wealth manager's business. Private equity, private credit, because of their marking cycle, they may not have that same volatility in a certain period. I think there's data that shows that private equity can outperform over certain longer periods of time and market cycles relative to public equities in certain cases. That depends on the vintage.
Private credit has demolished public fixed income. Demolished.
Yeah.
Like it's not even a horse race anymore.
Yeah.
So that's a good point. What do you say to the people who would listen to that talking point about the lack of day-to-day volatility because there are no marks for 90 days. I'm sure you've heard the criticisms of that. I'm sure you've heard great defenses of that criticism from the industry. So Cliff Asness calls this volatility laundering, and he flies into a rage over this. And I
No,
totally,
he's right. He's rightly bitter. It's
I
not
get
fair.
it because he has.
Yeah.
So he has a portfolio of public stocks and bonds. He has to answer to clients, why am I in a 15% drawdown over the last month? Whereas the private equity manager kind of gets to skate through a lot of that, unless it's a sustained drawdown, and then the marks will come down, usually on a delay. So, like, how does the industry respond to that? That I don't want to call it a charge, but like that criticism, like, don't tell me lower volatility.
It's not a charge. That's the point.
I think there's
it's right. It's one of the benefits of the asset
That's
class.
like the selling point.
So I think there's definitely on both sides, there's some where you sit is where you stand element to it. So
we all have our
philosophically,
biases,
people will
right?
have their biases. People who are in private markets will have their biases, and people who are in public markets or in hedge funds will have their biases when it comes to how they're thinking about that. I think there's valid points on both sides. I think it really comes down to what does a client need and what do they want and what's appropriate for their portfolio. I think whether you're a traditional asset manager, whether you're an alternative asset manager, the most important thing is you have the right product structure at the right time that's delivered to the right investor. And that could be for a certain client. Maybe that's a closed-end drawdown fund for a QP client who has $100 million in net worth and they want to invest in private equity. They can take that illiquidity risk. And as long as, and maybe they're working with an advisor or a team that can build out that private equity program and that understands that they're going to have a J curve in the first few years. So they're going to be paying out money effectively for capital calls. They're not going to be seeing money come back. So the IRRs might not look great relative to if you put it into public equities, today, or maybe not 4 or 5 months ago, but 8 months ago or something like that, right? And then you have to think about it over longer term. But then by year 8 or 9, you'll have the harvest period and you'll be getting capital back. And in an ideal world in a private equity fund, you're getting more capital back than you put in. So over a 10-year period, if you smooth out the IRRs, then that would have bested what you could have done over that same period in public.
You have to wait a
equities.
really long time to be able to determine this 10% allocation we put into private markets was a good alternative or a bad alternative. Like, you really have to wait for that harvest period when you start pulling your money back out.
Yep.
And look, this is why it's predominantly an institutional market, because most normal people, it's hard for them to wrap their heads around investing with a 10-year. We do it all the time with 401ks, but it's still hard.
Yeah, I mean, great point in two contexts. One is maybe 401ks, again, with the right managers, with the right structures for investment. And there's the regulatory and legal side that needs to be figured out. That, I think, is still in question despite the executive order. Maybe that's the right vehicle for that because it's capital. It's
the money's locked up anyway.
Yeah, you're not going to.
I agree with that part of it.
Take the money out, and you don't need it.
Yeah.
And you don't need it in a year from now. You don't need it in 3 years from now. So, I think that's an important piece of this. Is you need to match the right vehicle or the right duration with what you're trying to achieve as an investor. I think the other piece of this too is like there is an element of private markets and building a private markets or private equity program that is very institutional in quality and in nature. And you need to have the ability to do that in order to invest in more traditional private equity. So that 10-year drawdown closed-end vehicle. We're starting to see that change in this industry with the creation of evergreen funds, where I do not call them liquid. They are very much not liquid. They are.
Tell our listeners what an evergreen fund is.
So evergreen funds they're not closed-end drawdown vehicles. Closed-end drawdown vehicles means you commit capital, and it's generally over a 3 to 5 year period that it's called.
The fund closes.
You can't get your money out. You can't call up and say, "Hey, I want to redeem."
You also don't put new money in. Right.
You don't. You commit $1 million. That capital gets called 30% in year 1, 30% in year 2, 40% in year 3. I'm just making up numbers, but based on the cadence of the investment managers, processing of deals, sourcing companies, and deciding to invest. An evergreen fund is different in that there's continuous ability to invest, There's also the ability to withdraw capital. There's nuances based on the type
Small
of evergreen
amounts.
funds. Yes, they limit the amount that an investor or investors can redeem in any given time because they need to manage the liquidity, but they're constantly looking at different investment opportunities. And I think this is the important piece of evergreen structures is that the firm needs to have enough deal flow to be able to handle both the amount of capital they raise, because they can raise in continuous offering format. It's not like most private equity funds in the historical context would say, I'm going out and raising a $25 billion fund. That was less common.
Maybe
a few firms do
maybe
that.
$1 million fund.
Exactly.
Right.
But like a CVC, they raised 26 billion euros in their last fund. So
Wow.
like we're going to go raise $26 billion or 26 billion euros. They do that fundraise for 6 to 18 months. Once that fund is closed, it's closed. To your point, you can't get in if you miss that close. I think that's an important point, though, for the advisor community and why evergreens can make sense for certain
Using evergreen
advisors.
and interval synonymously.
Evergreen funds, I think of as the broad umbrella term for interval funds, tender offer funds. Those are different types of structures.
What's a tender offer fund?
Tender offer fund and interval funds are both, they can be closed-end or open-ended, but tender offers mean that there's a period where investors can actually tender some of their capital for redemption. Versus interval fund, there's specific intervals. Yes, generally quarterly. Although in a tender, there's a board.
How tender are we talking? Medium rare?
Depends. Some people like their steak a little more well
so
done.
just on the surface, the interval fund, the evergreen fund, makes way more sense for wealth management than the traditional closed fund because we're not institutions. We're human beings. Things happen in our lives, and maybe we can't demand the right to get 100% of our capital out. But if you tell me, God forbid, you go into a stretch in life where you need to reinvest in your own business or something horrible happens to a family member, it's not 0% liquidity. And vice versa, regular people don't typically make their money via windfall. They make money over time, over years. So having a vehicle that they can add a dollar amount into every year makes it more utilitarian for that person. So I totally get why that structure has become so popular. What percentage of the assets that the Wealth Channel is putting into alts would you say is going into interval funds right now?
Most of it.
I don't know the exact number.
It's like almost all?
Depends on how you define the Wealth Channel. Again, like if you think about family offices, then I think
No, it's
that's
RIAs.
different. But
Those.
the RIAs.
It's mostly interval funds.
Well,
Yes.
RIAs and Wirehouse is mostly interval.
So and this is public data, but iCapital had talked about this, that because they have over 240 or so billion, maybe I'm off by a few billion at this point, of assets on their platform. They do both closed-end funds, but they do a lot of evergreen funds on the private market side. A good portion of their flows have been evergreen funds. They're working with the Wealth Channel, and it's all advisor-led. It's wirehouses and it's RIA channel or independent channel. The majority of the flows are through evergreen structures.
You refer to the iCapitals as placement agents? Is that not the right
I think
term?
it's more of the pipes and plumbing of.
So they call themselves a platform. Everybody wants to be a platform now.
No, they are.
But they're also directing advisors toward one fund, not another.
There's different models. iCapital has multiple models. And for context, I was an early employee at iCapital. I helped build the investor network or distribution team.
Crushed it with that.
Thank you.
Just saying. Look at it. I mean, look at it now. You got to be very proud of that.
Yeah. I mean, look, I think the market structure needed to be built, just like the pipes and plumbing of equities, fixed income derivatives needed to be built and has evolved over time and has become more electronified over time. Private markets is obviously much younger. I mean, Blackstone is a 40-year-old company. They're the biggest, $1 trillion plus of assets. It's still a young industry when you think about the size and scale. And if it is 25 trillion of total assets in private markets, I mean, equities is what, 110 trillion. Fixed income is similar number. Like
the reason I love what you did is that I existed in this industry prior. And there were a lot of advisors who wanted to sell private investments to their clients. It was a wild west. There was no platform where you can look and say, compare this fund to 3 of its nearest peers and let me rank it on different. It did not exist. There was no way to automate the paperwork process or explain what the paperwork means that your client's about to sign. Did not exist. You had guys running around with PPMs, private placement memorandums, doing Reg D offers, like just ridiculous conversations, extra legal in many cases. And what you have done, and I know there are others, but like those platforms that now exist, I think they have brought order to a very chaotic process.
I think
even if you don't like the investments, you gotta agree that they are good for investors. The fact that this exists,
I think that's a big piece of the puzzle to making sure that the wealth channel is served properly. Because if you think about it, yes, the investment is important. So I don't want to minimize that. And selecting the right fund is absolutely critical. It's probably even more critical in private markets than it is in public markets. But putting that aside for a second, just the operational challenges of investing in a private fund, whether it's a drawdown closed-end fund or even an evergreen fund, unless you create the straight-through processing system leveraging technology, it's much harder to do. And that's why it's been so important. And I don't think the private wealth investing in private market story can actually take place without the technology market structure evolution. Those two things can't be decoupled. Yeah. You need that evolution from pre to post trade in private markets, just like you had in equities, fixed income, and derivatives. And that's the other piece of this is you have to create the right packaging and the right post trade processes. Because the example you gave earlier about the client needing to make sure that it's easy for them. I think part of the reason why an evergreen structure is important for the wealth channel is it's also helps the advisor run their business. They don't want to have to wait to the next drawdown fund to be able to put a new client who comes in. You deal with this all the time. You have new clients who come in.
I will allocate you in 5 years. So, right.
Yeah,
you can't do that.
You want to have an evergreen offering that you can say, hey, I just had a new client came in. I can allocate to this manager because this is part of our private equity program. We've vetted this fund or our private credit program. We like this manager. We have an account with them already. We've worked with them across our client base. And that could be
get in today.
Accredited and qualified purchaser. And you can put a $10,000 minimum or $100,000 minimum in for one client. And then you could put a $5 million investment in for another client. And it makes it easy for the advisor. And I think that's a big piece of this too, is you have to meet the advisor where they are.
One of the other big parts of the story, the less cynical part of it, because we address that part, institutions are full, the wealth channel's next, okay, is that the actual investment story here is that 83% of the companies in the United States that are doing $100 million in revenue are privately held. I'm sure a lot of them are private equity backed. The other side of it is the private credit side. And private credit's just, it's bonds for these private companies. It's loans. The
non-traded junk bonds they prefer.
No. These,
sorry. JK.
This part of the market, banks were regulated out of. And so in stepped these Blackstones of the world and said, we could do it quicker. We don't have to syndicate it. We have an endless supply of money. We can do the underwriting better. We can negotiate if things go wrong. And it's all playing out. And that is a huge part of how we got to where we are today.
Oh, 100%. I mean, so you mentioned let's talk about the private company side. 87% of companies in the US with 100 million in revenue or greater are private. Similar numbers in Europe and Asia. So I think it's a really important, that's an important point to make, right? Which is
it's the whole universe of investable assets and almost none of them are traded.
And if you don't have access to that, you're missing out on all of that in a world where what NVIDIA is 7-8% of the S&P 500, and you have indexation, you have correlation, you have concentration, and the rise of passive. All of those things, I think, if you're shut out of investing in the private markets, and again, I want to put the disclaimer on because it's important that you need to make sure you're investing in the right companies or the right funds.
How is that all?
So that's the important piece. That you can't just buy the index.
You can't just fire up the spaghetti cannon and just start throwing. Okay.
But part of that story.
Are you writing this stuff down for me, Duncan?
But Michael, part of that is this. So I totally understand private credit. It is wherever it's going, 25 trillion, it's going to 40, whatever. I believe it. I 100% believe it. The problem is, as I see it, I get legitimately a dozen emails like this a week. And I just picked the most recent one. I partner with RIAs, family offices, and institutional investors seeking differentiated private market opportunities. As a blank billion-dollar private credit manager, we originate loans in niche markets. Our portfolio is 100% senior secured, producing 12% annual cash distributions and a 17% IRR with a $2 billion track record and blah, blah, zero credit loss. Okay. Is there too much money chasing too few deals where the terms are getting shittier because there is just a torrent of capital because the advisors, the easiest thing in the world to sell is 12% income returns, and they're steady and there's no volatility. It's the easiest thing in the world. Is that the danger?
You said there's 11,000 private equity and private credit managers. Doesn't that sound like too many?
There's too many.
It's a lot. And I think that number is going to shrink because there's going to be consolidation in the market because the biggest players are going to buy.
But to his point, so it is crowded today and everyone's getting increasingly desperate to raise money. Not the big firms, but everyone else. And the terms are getting worse. And what do you make of that level of activity just generating bad outcomes?
I'll talk about both sides because I think there's credence to both sides. And I think
Michael, look at that chart. Sorry to cut off, but we're looking at percentage of covenant-light term loans. It's basically 100%.
Yep.
Is this
covenant-light, meaning the protections for the end investors are lesser because the desperation
I'm sure
to raise money is
this
higher.
misleading? What's going on here?
No, I think
you will answer for it now.
That's the case. There's an increase in PIK coverage, right?
Payment in kind, where the company can't come up with the cash. So they'll just issue more bonds or more shares in lieu of that's never a good sign.
All of those things are true. And that is a cause for concern for the private credit industry. I think it's worth zooming out for a second on this, which is private credit is a $2 trillion or so industry today. It was a few $100 billion a few years ago, so it's grown massively. Anytime an industry grows fast, I think you have to take stock and step back and say, okay, is this growing too fast? Is there too much capital being raised and then deployed? All of that is true. I think what I would also say is if you believe what some in the industry are saying, so like Mark Rowan from Apollo, one of the biggest credit managers, close to 700 billion of AUM, a large portion of that is in credit. And he would say that it's a $40 trillion marketplace over time. And that's because banks have been retrenching. There's been regulatory reasons for that. 40 trillion, yeah.
2 trillion to 40. No wonder there's 11,000 firms chasing it.
Yeah, I bet it gets there.
So 11,000, just to be clear, that's Dave Layton said that from Partners Group. They're a big manager. That's private equity managers. That could be private equity managers who also have a private credit arm as well.
I think the lines are blurring very rapidly. I think they're all doing it.
100%.
Yeah.
There are a lot of managers chasing private credit and the opportunities there. And private credit and private equity are related too, right? Because a lot of the private credit activity to date has been into sponsor-backed deals. So private equity, you need the leverage to do the private equity deals, et cetera. That's changing a little bit. They're doing private credit across different categories within the space. So things like asset-based finance, so like aircraft leasing as an example. That's a different part of private credit. There's real estate credit. There's infrastructure credit, which is starting to grow as the infrastructure asset class grows. So I think private credit actually might be a lot bigger when you think about it's anything that, not anything, but a lot of things that could otherwise have been on a bank balance sheet. Again, we could take both sides of this argument, and I think there's probably worthy arguments on both sides. But those in private credit would argue that it actually is. It may be a concern for those who are investing in private credit if the space grows too fast and people start to compete for deals by loosening up terms. That might be bad for the investors, but there's also a set of people in the private credit industry who would say that it's actually good if you're taking that off a bank balance sheet because there's less leverage in private credit than there is in the bank system.
What does leverage look like in private credit?
A few turns at most.
So what does that mean exactly?
Two to three times, maybe. And it's usually, some managers are doing less than a turn of leverage or 1 times leverage, but banks are generally leveraged 8 to 10 times or so. So again, I'm not here to defend private credit. I am not the foremost expert on private credit, to be clear. But I think when you listen to what the likes of a Mark Rowan from Apollo is saying about this being a very big market that could be things that banks.
Well, he better
could
hope
be,
so, because the banks are not going to stay out of this any longer. I listened to what JP Morgan had to say on the subject. Jamie Dimon spent like 8 to 10 years subtweeting this industry.
Yeah, you think Cliff Assis is mad?
Right.
Yeah.
So the bankers,
They looked at buying Monroe Capital, which is a $20 billion.
So Jamie is like, yeah, we know about these fly-by-night lenders. They're not going to be here in the next crisis. Well, two things. We haven't had a crisis, is one. And then two, we are now going through this massive deregulation wave. And I guarantee you, by the time Trump's term ends, all of the banks, the big ones, are going to have their own products competing with Ares, Apollo, etc. They're not just going to watch this shit anymore.
No.
If you tell me private credit's $2 trillion going to 40, do we honestly think like Goldman, Morgan, JP Morgan, they're going to just sit here and watch it? Or they're going to take a slice of fees for introducing a fund to their clients? No way.
What happened with Goldman and T. Rowe today? What was the news there?
So I have this. Can I read this?
Yeah.
I would love to get your reaction to it and whether or not you think we're going to see more. Rowe Price had a really big upside day today. Where the hell did I put this? Oh, here it is. Bear with me. Rowe Price shares rallied Thursday after the asset manager struck $1 billion deal with Goldman Sachs to sell private market products to retail investors. Goldman will buy up to $1 billion in Rowe Price common stock through open market purchases. Bullish. The two financial firms will team up to offer wealth and retirement funds that give access to private markets for individuals, financial advisors, plan sponsors, and plan participants. And then David Solomon did like a PR quote. But basically, like, T. Rowe has the infrastructure to sell funds in 401ks, to advisors, through banks. Goldman has the private equity assets to put into those funds by virtue of all of their whole ecosystem. T. Rowe doesn't have what Goldman has. Goldman doesn't have what T. Rowe has. It's brilliant. I totally get it. We're probably going to see a lot more of these tie-ups. Okay.
100%.
Yeah.
We've seen it in the reverse with BlackRock trying to build out its private markets capabilities by acquiring HPS and
How about
GIP.
Vanguard partnering with Blackstone?
Blackstone and Wellington.
And Wellington.
That was
Okay.
The three-party partnership. So I think that what we're
Fees
seeing
are going
is
down, though, if this continues, because like these are mass market players that they can afford to undercut, charge less. I don't know. It seems like a double-edged sword for the industry.
Depends on the product construction. But yes, absolutely. I think we're going to see more of this. I think this is the type of thing where firms will try to match their capabilities. Goldman, to your point, they have the private markets capabilities. They have $550 billion or so of AUM in private markets. That they're not a pure play alternatives manager, but if they were, they'd be a top 5 in terms of AUM. So like that's meaningful. They get to distribute their products through the T. Rowe Wealth channel. T. Rowe, and it could be Franklin, it could be BlackRock.
It will
could
be BlackRock.
others.
BlackRock is going to have model portfolios for advisors very soon. And Larry Fink's annual letter, on like page 5, he just went all in. He said, BlackRock has always had a foot in private markets, but we've been first and foremost a traditional asset manager. That's who we were at the start of 2024, but it's not who we are anymore. In the past 14 months, we've announced the acquisition of 2 of the top firms in the fastest growing areas of private markets. That's Global Infrastructure Partners
GIP
and HPS.
And HPS.
We bought another firm to get better data and analytics. That's Preqin. So we can better measure risks, spot opportunities, and unlock access to private markets. We've transformed our company. That is the biggest asset manager in the world going all the way in on private markets. If it feels late, we're just getting started.
We are just getting started, right? Because think of how much capital can go in to private markets from the wealth channel. A lot of the advisors who BlackRock or T. Rowe or Franklin, and then all these alternatives managers are working with, and certainly on the traditional side are selling traditional products, mutual funds, ETFs, et cetera. They're very underpenetrated in alts, whether they're wirehouses or RIAs. So I think we're going to see more of this just because you have to be able to spend a lot to do distribution well. Blackstone has 600 people or so and a huge team and budget, and they've spent a lot of resources to build out their footprint in private markets because it is a ground game to sell. Now, what do traditional asset managers have? They have distribution.
How do advisors figure out which of these firms to talk to and who's best at what product type? Is it just like you learn from just like reading, or?
But Michael, part two of that question is when hedge funds came along, not when they came along, but it was often said that assets are an enemy of performance. I feel like with private markets, private equity, especially private credit, scale is really important.
Yeah, I think it might work the other way around.
So
yeah.
how do advisors know who to work with?
Just call Blackstone and BlackRock and call it a day. Is that all you need?
I think there will be a portion of the market that probably does that because what you're getting at is
Reputation.
brand wins. And so I think the nuance to your question, which is a really good one, because it, I think, gets to the core of what all of these asset managers are thinking about in their C-level strategy discussions, boardrooms, et cetera, is how do we show who we are? What's our DNA? What are our values? What's our culture? And how does that transmit itself in terms of our investment culture and our brand? And how do we market that brand to the wealth channel?
I got to be honest with you. Advisors don't care about that stuff. I think it's what is a big enough name that when I say it to my clients, they're not afraid anymore. And what's the price? I have to be honest with you. I don't think that branding culture shit, like nobody cares about that.
But that's a really instructive. I'm glad you said that because that's really instructive and an important
Do you agree
piece
with
to
me
all
that
of
I'm
this.
right
Wait,
about
hold on. But think about it this way. I think you're right to a certain extent, but to the extent that culture is the people, it matters a lot because how many relationship managers have we worked with that have had a very impactful part of our decision-making process and who we will and won't work with?
Several.
Right? So from that respect, it does matter.
No. But how do they even get to the table to begin with? Because the company
Yeah.
was sufficiently large
100%.
and we believed in
But they have to have great
brand.
people that are trustworthy, that can educate,
No,
build relationships.
I totally agree with that. What I'm saying doesn't matter. These highfalutin mission statements that have been crafted by a publicist.
Yeah, nobody cares about that.
Advisors don't give a shit. They're not reading the marketing materials.
That's why I think asset managers really need to think about how they want to evolve their brand to work with the wealth channel. To your point earlier, Blackstone has figured that out. They have John Gray being very authentic, doing running videos, being on LinkedIn.
Yeah, is he rapping?
Like
so they're all going to start rapping? Is that what's going on?
Maybe. I mean, I think every firm needs to be.
Can we have a little bit of fun? Can we do a little free association?
Sure.
You were saying on another lesser podcast that every one of these companies has sort of its own brand and its own like idiosyncrasies. So I'm not terribly aware of the difference from one to the other. I know there are a lot of memes being made about this now, which is fun, and I follow all those guys and gals. So I'm going to tell you the name of one of these firms.
Yep.
You don't have to do it in one word.
Name an animal that you associate it with.
No, you don't have to do it in one word, but like help us understand the cultures of which you speak.
Sure.
Okay. Apollo.
Purchase price matters.
No. God of light. No, say that again. What is it? Purchase price matters?
Purchase price matters.
So they're disciplined on what they're
price sensitive. They're disciplined. Their DNA.
Okay. All right. Aries. God of War. It's a God of War. Okay.
My Greek mythology wasn't good. I probably need to study up on that if I want to know all these matters.
Why do they all have to be Greek gods? What, is this like a superiority complex or
inferiority?
Could be. Aries, I think of they obviously do a number of things, but when I think of Aries, I think of a fantastic credit franchise and an innovator in structure around credit and BDC world.
Okay, KKR.
Everybody's going to say barbarians at the gate. I actually think they've. I think of them as a.
You could say pass.
When it comes to private equity and that they do other things, obviously, I think of them as a private equity firm to start. They've done a lot of other things, but.
So just do a minute on GP stakes. We haven't spoken about that.
Wait, I got two more. I got to get to these. People care. Carlyle Group.
Private equity heritage.
So okay, so like the heritage.
David Rubenstein. I mean, they were one of the. I mean, there were obviously a few firms that were first: KKR, Apollo, Blackstone, Carlyle's in that group. I think of them as private. Now they've obviously expanded beyond that, but they're also a high quality brand. I mean, these are all high quality brands, just in slightly different ways.
Blackstone, the biggest, right?
Behemoth.
Behemoth.
And they use Steve Schwarzman said a quote. I had this former CFO of Blackstone on my podcast a while ago. He made a really important point and a really instructive quote, which was quoted Steve Schwarzman, who apparently always used to say, scale begets skill. So his view is scale is their advantage as a firm because scale begets skill. If you can put enough scale against an investment opportunity, that requires skill, but B, you then have an advantage. And that's why I think they've leaned so hard into scale. They've raised very large funds, but scale is what enables them to have an advantage in winning deals. I think this actually relates to private credit a little bit too. Is it like
an IBM thing where there was like the old saying, like nobody ever gets fired for choosing IBM? Does Blackstone sort of have that aura about them where it's like, when in doubt, we'll just use Blackstone? I feel like the
B-REIT thing sort of blew over.
And
by
that's
scale, they did a deal with CalPERS.
They figured it out because they have the scale to figure it out and they have the brand. And I think they've used their brand to be early and educate the market very early on. Blackstone University was an innovation in the space to educate advisors. But they've also put a ton of capital. And I do think that in order to work with the wealth channel effectively, and this is partially why we're seeing partnerships, this is why we're seeing consolidation, you need to invest enough capital.
You need people. You need wholesalers.
You need people. But you actually have to invest enough capital to do that. The firms that have the scale to put their balance sheet and invest capital to do all of that and are willing to spend on marketing.
You need local area like shock troops 100%. Who could show up and befriend.
You need John McKenty.
You need John McKenty.
How do you go to Edward Jones?
John's at
if you want to work with them, right? You got to be.
I have a guy who covers me. I have a guy who covers me for BlackRock.
No. He's at Allspring.
Excuse me. Oh, he's at Allspring now?
Yeah,
all right.
Of course he is.
Forget the story I was going to tell you. Everywhere I go, I just run into this guy. He covers me so well. I'll like show up randomly in a restaurant somewhere and he's like, hey, good to see you.
Did you share your location with him or something?
No, it's crazy. He's so good at what he does. Unbelievable.
Michael, what area of the private markets? There's so many different areas. We haven't even spoken about really data centers, infrastructure, GP stakes. What area are you most excited by? Or what do you think resonates most with advisors?
I think what I'm most excited about is not necessarily the same as what resonates most with advisors. I think private credit resonates most with advisors now for the reasons you discussed. And I think it's also it's an entry point into private markets because it's not as illiquid as private equity.
Very easy to understand.
It's loans to companies.
Yeah, we get it.
There's a current yield. I think that's an important piece of this too, which is advisors
income.
They want income generating assets.
And guess what? In 2022, when rates went up, these things are floating rates. They didn't get killed. The opposite, they did great.
Exactly. So I think private credit has been the first foray for many advisors. Secondaries, I think, is also very popular right now because similar thing. It's there's a structural imbalance in the market. So there's a lot of capital that needs to be unlocked, and there's been a lot of capital raised in the secondary space, but there's still reason to believe that the secondaries firms can have their pick of what assets they want to go after. Now there's structural challenges in private markets, and there's innovation around different kinds of funds.
Prior to secondaries becoming as big as they have, you really had to rely on going public. That's increasingly difficult to do.
Number of private companies
a lot of companies don't want it. Investors, the risk appetite after the first day or two, they abandon these companies. You don't have the research coverage on Wall Street to support a small cap or a mid cap company. Like the analysts there aren't enough analysts to cover all these. So for that reason, that's the structural imbalance. You don't have the liquidity from public markets. I guess philosophically, when you have secondaries, these are almost like public securities at that point.
Well, OpenAI just did one. This was in a secondary, but their employees were able to set a $500 billion valuation. And yet, a lot of these private companies, even the giants like OpenAI and the others.
Is OpenAI not a public company?
It's $500 billion. I mean, it's going to be past Walmart soon.
That's a great example, though, of what private markets has become, right? Yeah. There's this evolution in broader markets where the number of public companies has halved from 2000 to today.
We have like 3,500 public companies. That's it.
And so
it's tiny.
How do you get access to the universe of company, like a $500 billion company that's private? And if they're doing secondary offerings, there's some level of it's not liquidity in the same sense as there's daily liquidity, but SpaceX does tender offers on a regular basis. So these big companies need to figure out how to create liquidity mechanisms for their employees and or investors. That, I think, is a great example of what private markets has become. It's an entire universe that probably should be, at the very least, if people are investing in meme stocks and crypto, they should also have the ability, if they want to.
But that part is still that part of the
assets.
market is still not built out for the everyday investor, not even close. Like
Sure.
even for RIAs, it's difficult to get your hands on those shares.
Sure.
And it's a pain in the ass.
And that's why I think this is going to be advisor led for a while, as it should be. The brokerage firms are starting to do this. Schwab announced earlier this year that they're rolling out private markets offerings to their QP client through brokerage. It still has to be advisor led. Either the brokerage client has to call up their advisor, or they have to ask for a Schwab advisor who sells private markets to be able to invest in it through their brokerage account. But soon you're going to see private markets products, probably evergreen structures, in brokerage accounts.
We're coming to the end of this, but I can't let the moment pass without asking you: is the douchiness quotient of the industry being like overplayed on social media? Is it not as bad? Because you probably know 1,000 people working in the industry. I probably know 100 or 200. I don't really find that these people are any worse than any other people I've ever met in finance. But like, let me play this for you, John. Can you hit that link for me? Topic 6 industry. Do you know who Johnny Hilbrandt is?
No.
Oh, you're in for a treat. All right. Do you have to log in order to play
So,
it?
Michael, what else is going on?
Yeah. What did you have for lunch today?
I'm ready for football season.
Who do you guys open with?
You're a Commanders
Giants.
fan? Is that
I'm a
because
Commanders
private
fan.
equity owned? Makes sense.
Of course. I mean, private equity came to save the
I know.
day.
Yeah.
Honestly, like,
Unbelievable.
It's so much better now than it was. For
so
sure.
does that say that private equity is it can be a good thing?
We're gonna see a lot of, I think, minority stakes in sports teams, and those are gonna be very popular.
The
with
Koch brothers
investors.
just took a 10% stake in the Giants at a $10 billion valuation.
Yeah. I mean, if you think about, so sports teams are an interesting one though, right? Because it's the media deals have just consistently grown in lockstep as more people continue to watch sports, as the streamers get involved. So, and I think there's been data from Arctos and others that sports are relatively uncorrelated assets to
we'll see
other
about that.
parts of the
No,
market.
they are uncorrelated. Come on. You still
They will be less uncorrelated if and when thousands of people are invested in them, and then all of a sudden,
dude, people are going to Knicks games. It doesn't matter what the environment is.
I think everything becomes correlated as
Not
more people
sports.
invest in it. You don't think so?
No.
I'm not 1,000% sure if I agree with that.
Who's the buyer once the Giants get to
Saudi
20
Arabia.
billion?
Saudi Arabia. I'm pretty sure Saudi Arabia is going to end up owning several major sports. It looks like they own golf. They forced a merger with the PGA. Like, that happened in a year. It didn't really take that much money either. So if you think that they're not going to end up owning franchises in sports or owning entire leagues, you're crazy. Of course they will.
You think the leagues will ultimately let that happen? They'll have no choice.
You'll never have enough money to. How are you going to compete with Saudi Aramco?
No, it's
trillions versus billions.
401ks.
We already know
401ks.
Yeah, right.
I'm going to own the Knicks in my 401k.
All right, are we not going to be able to do this?
I'm having issues getting it in. Yeah.
All right, can I play the audio?
Yeah, you can just play the audio.
All right, it.
It's not letting me
We'll
screen
go
share,
audio.
so I'm working around.
All right, hold on. Let me see if this works.
Leveraged buyout. Yeah, Sycamore. Yeah, Sycamore just dropped an insane $23.7 billion on Walgreens. That's so sick. It's the largest retail LBO in history. And so they took the company off the NASDAQ. Yeah, you know that play. Oh, it's going to be so sick, my man. Well, yeah, Walgreens appears to have more annual revenue than any other company that's ever been acquired by PE. So that's substantial. And look, I know a couple of the guys over at Sycamore. They're really salt of the earth fellas. I've golfed with a few of them. One of them has a son on Tarantino's squash team. And actually, the other, Tarantino spars with one of the other guy's sons in jiu-jitsu. Yeah, they're 4 years old. Yeah. Yeah, very cool. Sorry, what was that? Oh, no, Sycamore has no healthcare experience. No. But those guys they're awesome. Yeah, they're going to absolutely print. They already were. I know one guy that I know, he was rolling up pediatric dental offices. Yeah, in Arizona, California. He's absolutely printing.
Okay,
Yeah, the guy only flies private. Yeah.
Oh, he's wearing a vest. Okay.
And he's 27. I'm so sick, my man. It's going to be very cool. I'm so thrilled for everybody.
All right, so that's
involved.
if you're on all right, enough. That's Johnny Hillbrandt, one of my favorite creators on Instagram. He's absolutely hysterical. I don't know if nobody's ever sent that to you before.
No.
He's done like 500 of these videos as the same character, and like it's the most pretentious asshole you've ever seen in your life. And all of his videos are like, I'm in Nantucket, now I'm in the Hamptons, now I'm at F1 race, like just on and on and on. And they're never not funny. But he doesn't work in the industry. I think he's a stand-up comedian. He just has this persona down to a science. And it's not my fault. That video I played for you has 6,000 likes. All of his videos blow up because everybody knows one of these people. He's obviously an extreme version, but like, is it unfair or is it sort of on the mark, or do you know these people and they don't represent the whole industry? Oh man,
I'm sure.
Look at the pause before he could.
I'm sure there are people like that. I think there's a lot of people in the industry who, one, really enjoy building companies.
Yeah.
And that could be investing in and building companies that they're investing in. And also, I think at this point, like the firms themselves are business builders. And I think they find that fascinating and interesting. Obviously, it's good for them, no doubt. But I think there's a lot of people in the industry who are not like that. I will say those focused on the wealth channel, and I've spoken with many of the wealth, but I've spoken with many of the heads of private wealth on my podcast. They're business builders. They're building a business within a business. I think they take their job very seriously and believe in the merits of private markets. They understand the importance of educating the wealth channel. They know that's critical, both in educating advisor and end client, if they want to actually be able to do this well. And I think they also know that if advisors don't have a good experience and clients don't have a good experience from the start, they won't work with them again. Advisors are very fickle, and rightly
one
so.
Shot. I totally agree with
you
that.
have one chance.
Yeah.
So I think a lot of those in the wealth channel who I speak with, I think they really do care about how they do this and making sure they do it right, so that private markets does become something that is another tool that the advisors can choose. I think the other thing that is important to say is we don't live in a world without memes. We never have.
Agree.
And we certainly won't anymore. We've gone through the memification of everything, but certainly the memification of financial services. I think that's an important point and something for those in financial services, asset managers, to really think about and understand, because I think they need to realize and think through how they want to work with the wealth channel. That might be different. They may have to evolve how they do things and think about things a little differently and lean into that a little bit in a way that's true to who they are and who their brand is. But also recognize that at the end of the day, finance is a serious business. It's people's money. That's probably, if not the most important thing, it's one of the most important things that people have and hold sacred, because it enables them to do all sorts of things in life, from take care of themselves and their family to do whatever they want. So making sure that advisors and end clients have a good experience, their money is safe kept, and they generate returns. Private equity and private markets don't work unless the returns are higher than public markets.
Right.
Why do it? It has to be done well.
Subject to the same pressure that every other asset class is subject to.
I don't know, man. I take minus 50 basis points for no liquidity. I mean, for no marks. I'd pay it. Honestly.
So the guy that's being caricatured here is not the guy that they would send to interface with a wealth management firm. That's more of like a portfolio manager. And he keeps saying, due to my role, I have substantial wealth due to my role. Like that is not the face that any private equity or credit firm would show to financial planners or fiduciaries.
No, and it
Never.
can't be. I mean, they really need to make sure they understand who the advisor is. There's different types of advisors. There's different types of clients. They need to make sure they're understanding what product they're selling, and they need to build their brand in a way that reflects who they are. I think we're going through a huge brand evolution in asset management. I think we're seeing this collision of culture and finance. And I think firms are going to need to lean into that. I think they are going to need to think about culture and how to appeal to culture.
Not just culture,
So,
but like how to broadcast,
Yeah.
like show people what your culture is about.
And they
So,
need to do it,
yeah.
but they need to do it in an authentic way. I think
I agree.
they need to be out there talking to people. They need to come on podcasts like this and just be able to chop it up.
Can I tell you something,
Like,
Michael?
That's important.
Can I tell you something? I think they could all learn a lot from paying attention to the way that you carry yourself and what you're doing. So I hope they are. I'm sure they are. And you do a really great job communicating the virtues of the industry. I could tell you're passionate about it. And we had a lot of tough questions for you. I thought you came through with flying colors.
Can I just say one more thing?
Nope.
You know,
So, all right, I'm just kidding. Go ahead.
God.
No. What do you got?
No.
I was rapping.
The moment passed. No, I know you were
Do
rapping.
you want
It
to
was-
say something nice about Michael?
no,
too?
no. The moment passed. That's okay. Go
Well,
ahead.
let's bring it back. I want to hear you
No.
say it.
Really and truly. It was a bad joke. It would have played, but the moment is over. Wrap it up.
I'm so sorry I stepped on that.
That's okay.
All right. Guys, want to say thank you to Michael Sidgmore for coming by. I want to tell people where they can follow you because I think like we did an hour probably doesn't do justice to all the things that are happening in your space. People are going to want to learn more as a result of this conversation. I know I do. Where should they follow you? Where can they get more information about the things you talk about?
So, alt goes
Put the
mainstream.
hat on. Let me
Put
say.
the hat on.
Yeah. Oh, wait, you got a headphone on. All right.
I gotta.
Sorry. Forget it. Don't do
This
it.
is coming your way.
You look crazy. Take it off.
I got some hats
Okay.
for you guys.
Alt goes mainstream. So that's
but
the
yeah,
pod.
so yeah,
Okay.
Alt Goes Mainstream is on Substack. So I write every weekend, and I have a podcast at least once a week, sometimes more.
Your Substack is amazing. I've told you that before. Excellent.
Appreciate that.
Yep.
Do people want to hire you like every day? Like how many people are trying to just be like, we'll buy your thing, just come work here? How it's got to be
It's
everybody.
happened. It has happened. I think. Look, I think it's important to stay independent. I work with a lot of different firms. I think that's part of the importance of this is being able to talk about what's going on in the industry and putting the pieces of the puzzle together for everyone
Yeah.
from a 40,000-foot view. I think every firm needs to have their own way of educating and their own amplification methods. That's through socials, through their own content that they produce. But I think also having independent platforms for that's important. So I want to stay independent.
Well, you have
So-
you have probably the leading independent platform for it. So I think it's
Thank
amazing.
you.
Hey, we always end the show asking people what they're most looking forward to. I'd love to hear anything in your life or in your business or any events you're going to. What are you looking forward to right now?
Future proof.
You could say
I am
future-proof.
looking forward to future proof. I've written about this. I actually really am. I think future proof is this great intersection of finance and fun. You guys have figured it out. You guys have figured out how to celebrate advisors and make sure that they understand who they are and how to build their business, but do it in a way that's fun. And I think
Are you bringing the pot out?
I'm moderating a panel.
Okay.
Uh,
Is it on alts?
on-
I'm
it
just-
is
I'm
on-
just
it is
guessing.
on-
Okay. All right. Cool.
It is
Good
on all.
idea.
There's a traditional asset manager on there too because we're going to
Okay.
talk about the convergence.
Okay.
But no, I think there's something that it's hard to explain other than seeing it in person. But people in casual outfits on a beach, but talking about really interesting intellectual topics within their industry, I think it creates this unique element that you can't get from sitting in an office or just doing a conference in Midtown.
Totally agree.
And I think that's I always look forward to it every year. I think it creates this way of just thinking about what you're trying to do as a business. I mean, the advisors are really they're trying to learn from each other.
You know who this?
So-
you know who this guy is?
No,
My friend
met-
Robert
we
Bahari,
met
and
a
he's
little
an
earlier today.
independent financial advisor in Australia. How many Australians do we have coming? Do you think 25 or 30 Australian? How cool is that, right? So shout out to Robert for coming by the studio. We really appreciate you sitting in for this. And
we had an audience today.
we're gonna have 30 financial advisors from Australia at Future Proof in California. I think the Canadians are sending over 100. So it's like it's really a cool thing. I'm so glad you're gonna be there.
Yeah.
And
Thanks for
I'll try
having
to
me.
catch your session. Michael, what are you looking forward to?
the
Life.
Giants losing to the
Oh,
Commanders.
Life.
Life. Giants. Yeah, Giants. we're
Football
back.
season's a good answer.
I'm looking forward to Russell Wilson getting out of New York. It's enough already.
yeah.
I don't want him.
Really?
I don't want him. It's.
You're on the Jackson Dart bandwagon? Is that,
I
is
don't
that what
s-
it is?
I
You know what's
wanted
going to happen?
Jameis
He's going to
over-
go
I hate
0-3, and the crowd is
So
going to
dumb.
demand Jackson Dart. That's my prediction for.
New York is a fickle market. It's-
Well, yeah. So we're very discerning.
You're a
Um,
Giants fan too, right? No? Or
Yeah.
you're
So
yeah.
So that's the thing I'm not looking forward to. I'm not going to focus too much on it. Honestly, I'll watch all the games, but I'm not going to get upset. It's not our era right now. It's just not right. You think that's fair?
I
not
would not.
for-
No, we bottomed last summer or last season.
I think we could be okay. It's just not. This is not like
It's
watching.
so depressing. I can't. Let's just
All
move
right.
on.
All right, guys, we're going to get out of here. Thank you so much to John, Duncan, Nicole, Rob, Graham, Chart Kid Matt, Sean, Keith, everyone who works on our shows, Daniel, Travis. What a week we've had. Huge thanks to our guest, Michael. Please follow Alt Goes Mainstream. Great podcast, great education. The Substack is lit as well. Guys, next week, what are your thoughts on Tuesday on the YouTube channel? Because we will be in Huntington Beach for Future Proof. We will have a Compound and Friends episode, though, at the end of the week, and it'll be live. We are hosting the CEO of Franklin Templeton, Jenny Johnson. Jenny is an absolute killer. Michael Batnick and I are so excited for that conversation. So look for that next week. Thank you so much for watching. Thank you for listening. We'll see you soon.